Good morning, everyone. Welcome to GovCon M&A, what is going on in 2023, predictions for 2024. I'm Jennifer DeCamp, Director of Partner Development at SB Liftoff. SB Liftoff is a national M&A firm serving the mid-market with a deep expertise in GovCon. I'd first like to take a moment to introduce you to our panel for today. Our first speaker is Sharon Heaton, CEO of SB Liftoff. Sharon has advised on transactions totaling more than $12 billion in deal value and has focused on bringing high-quality M&A advisory to the mid-market GovCon space. Sharon got her law degree from the University of Chicago Law School, a BA from Barnard College at Columbia University, and has been associated with the law firms of Skadden Arps and Latham and Watkins. Next, we have Todd Overman. Todd has established himself as a leading government contracts practitioner at Bass, Berry & Sims. He is managing partner of the firm's Washington, D.C. office and chair of the Government Contracts Practice Group. Todd has nearly 2 decades of experience advising companies in meeting the demanding and ever-changing regulatory environment of contracting with the federal government. Over the last decade, he has advised on more than 50 transactions involving the purchase or sale of a government contractor. Todd has experience in structuring transactions and corporate reorganizations to ensure compliance with the Anti-Assignment Act, as well as navigating the rules impacting the acquisition of small businesses. Next, we have Ken Dodds. Ken is a vice president at Live Oak Bank, a publicly traded FDIC insured commercial bank that lends nationwide, providing government contractors with over $700 million in capital since 2016 for mergers and acquisitions and lines of credit, including over $200 million in 2022. He joined Live Oak Bank after 21 years at the SBA, where he was a senior executive in the Office of Policy, Planning, and Liaison, responsible for federal government contracting regulations and policy. Todd graduated magna cum laude from James Madison University and received his law degree from the Marshall Wythe School of Law at the College of William and Mary. Over the next hour, we encourage you to submit questions through the Q&A option at the bottom of your screen, and you can submit questions throughout the presentation, and the panel will take the last half of the webinar to answer your questions. So let's get started. Sharon, why don't you kick us off by giving us insight into the future of GovCon M&A?
Absolutely. Thank you, Jennifer. And let me start off by saying how pleased I am to be here with Todd and Ken today. And we're delighted to kind of give you our perspective of what's going on. And we'd very much be interested in your questions and seeing if we can be helpful in answering them. I want to start off a little bit about 2023. We're in basically the fourth quarter at this point. So we've got a pretty good sense as to how 2023 has played out and how we expect it to continue to play out. And then we'll make some comments about 2024. 2023, from my perspective, has been a very good year for M&A. GovCon M&A does not go up as high as the commercial market does. So the valuations don't go flying up as they did for the commercial market in 2021, 2, and 3, or 22. But it doesn't go down as much either. There's much more stability in the GovCon market. That's really been borne out in 2023. You read articles in the Wall Street Journal and virtually every publication about how M&A has decreased substantially in 2023. There's 2 factors about that. The first is they're comparing it to 2021 and 2022. And that's a little bit unfair. 2021 was an absurd year for M&A. And to compare a year as not being as strong as that is a little silly. It's been an extremely stable year. It's been a good year. It hasn't had the frothiness of 2021, but that's probably a pretty good thing. Second is that it very often when you're seeing in the press about M&A, they're talking about publicly traded deals. They're talking about very large deals where Goldman Sachs or whatever is going to make a huge amount of money on doing a transaction, and there's less of that. So, oh my God, their bonuses have to be cut. Don't care. The reality is in the GovCon market, again, there's more stability. It doesn't go up as high. It doesn't go down as low. And I'm finding that the numbers of transactions is about the same. The real difference between 2023 and 2021 is that in 2021, some companies got sold at valuations that they could not get in 2023. But they were surprising valuations in 2021. And so I think that the market has kind of returned to normal. And by normal, I mean, If you are in the what I refer to as the designation market, you've got a small business, SDVOSB, women-owned, et cetera, you're probably going to have an EBITDA multiple, adjusted EBITDA multiple of between 3 and 6. Maybe that had gone up to 7 earlier, but not a lot higher than that. In the commercial market, it could go up very high. On the other hand, as you start going into the full and open market, your EBITDA multiples, and that's really core to your valuation, would probably be from 4 to 9, depending upon the kind of company you have, security clearances, the amount of backlog, et cetera. So there is a tremendous value for GovCon owners to be in the designation market. You can get work that you might not otherwise be able to, but to the extent that you can break into the full and open market, even for getting 20%, 30% of your backlog from full and open, begins to provide real value to that business owner. So 2023 has basically been a very good, stable year. Not surprisingly, there's always more deals that are under 10 million than above 50 million. Big surprise. But the market is pretty active. We're seeing a lot of buyers looking to get into GovCon. And as somebody who might own a GovCon company, be careful. GovCon is its own world. And it's hard for a buyer to get an understanding of your company generally, regardless of the deal. It's even more challenging when they're going into a sector that they don't understand. And let's be honest, we have more initials and acronyms than you could possibly imagine. So when you're talking to a buyer and you're talking about IDIQs and BPAs and NICS codes, and their eyes start rolling back in their head, that might not be the right buyer for your company. If you're involved in GovCon, having people who understand GovCon will get 30% of the way there than if you have to teach them about GovCon at the same time. So again, the market is pretty stable. There is a lot of sellers, there's a lot of buyers. Valuations strike me as pretty normal, which is a little interesting considering the increase in interest rates. I mean, the general thought has been with interest rates going up, valuations would go down. And I can't tell you that it's had no impact. It certainly has. But it has not had a tremendous impact, in part because people buy GovCon companies not for the financial engineering, but rather because they think that they can take it as a platform and grow it from there. So the extra 100 or even 200 basis points has not been a huge issue. Where I have found it more significant is in the lower part of the market, in smaller deals, where people are relying upon SBA loans. Because SBA loans now are in the 11, 12%, which I used to consider credit card range interest rates. But that's where, SBA loans are right now. So while it used to be pretty easy to go get an SBA loan and you could do a deal for $6, $7, $8 million with some seller financing and some SBA and maybe some equity rollover. Now it's a bit more challenging, and that interest rate differential is material. So I used to say that an SBA loan is a great option when you have no other options. That is, the commercial loans tend to be less expensive, but the SBA loan has the benefit of being able to be issued more easily and having a much longer amortization. That is, you can pay it back over a longer period of time. Now the interest rates really are quite significantly differential, and that becomes a factor in some of the smaller deals that we're seeing. In bigger deals that are largely relying upon commercial banks, and Ken, I'll be very interested in your views on this, it seems as though while the increase of interest rates is, of course, always a factor, it's been having less of a factor than it might have on the deals that were truly relying upon the SBA loans. With that, I'd love to hand it over to Ken and get your thoughts as to what you think about this year, next year, and anything else you want to talk about.
Yeah, thank you, Sharon. I'd like to echo a couple things that you said, and then we'll get into the financing part of it. I think we're on pace to do kind of what we did last year. There's, in this market, I've been doing this since 1998, government contracting. Acquisition is part of the ecosystem. It's part of how things operate. You grow your business. You start out by yourself in your garage. You grow your business. At some point, you're going to acquire to get bigger, or at some point, you're going to build something that's valuable and someone's going to acquire you. That's kind of how the market works. In terms of valuing business and getting a loan to buy a business, the backlog is a very important. You do start with EBITDA, and there is a multiple, as she mentioned, of between 3 and 6, depending on what type of work you have and how easy it is for someone to buy you. But you're never going to be more valuable than when you just get a big award where you have a lot of runway left and all that, because banks are going to look at your backlog, stuff that's actually been awarded, contracts that have been awarded, or orders that have been awarded under IDIQs, and say, okay, we're going to, if nothing else happens, if they never win another contract, they're probably going to make this much money, and that'll be able to finance the acquisition. So the backlog is incredibly important. I like to tell.
Ken, could I interrupt you there for a second?
Yeah.
Because one of the things that I found is, first of all, I completely agree. Backlog is the key in so many ways, backlog, margin, etc. But I find that a lot of GovCon companies are a portfolio of their contracts. And, it sometimes becomes more challenging when you just won a lot of backlog, and that's great, but you've got a company contract coming up for recompete in 12 months from now, and that recompete might represent 20 or 30% of your revenue. So it's almost like looking at a moving circle of where are you on your backlog, and absolutely agree that to the extent that you can go to market when your backlog is at its maximum level, you're going to be doing particularly well.
And 100%. And as we all know, these deals can take 6 months or a year, or they'll crash and then they come back. I mean, it's always a moving target. So what you're talking about, the recompetes, that's kind of like a pipeline, but there's a big difference between a pipeline where this is a recompete, you're going to be eligible, and you've won it the last 2 times it's been up for bid, versus just a shot in the dark where you want to get something on your pipeline, but you have no better chance than anybody else to get it. So that's definitely part of the valuation is the recompete, and how do we negotiate the likelihood of getting that awarded.
Hey Ken, before you get
Yeah.
off that topic, this is Todd. We had a question come in. When you're looking at that valuation, are you focused on funded backlog or just contract value backlog?
We consider, it's hard to get a contract fully funded for 5 years. I mean, the way at least a lot of agencies do contracts is they award a 1-year base, your standard contract with 4 1-year options, and they typically fund that year to year. But there's a difference between, a contract that's been around, this is the 3rd iteration of it, they've funded it every other year, versus a contract that has a bunch of options that may or may not be exercised. So from our perspective, if it's awarded and we have no reason to think that they won't exercise the option, we kind of give the value to that. And I wanted to touch on a couple funding things that Sharon mentioned. I mean, I try to tell people as a rule of thumb, when you're doing conventional lending, which is primarily what we do because of the values of the deals that we work on, you're looking at a debt to equity ratio of 50-50. I mean, every deal is different, but a rule of thumb would be 45-55, 40-60. You're going to have to bring some equity to the deal, which is a lot different than the SBA loan, which I'll talk to in a minute. So there is going to be a little more equity for a conventional deal, and the timeline to pay it back is going to be typically 4 to 5 years for the things that we work on, because obviously we know that most government contracts, your standard one is a 5-year deal. So that's how we typically deal with the conventional. When you're talking about SBA loans, they do have some advantages. One of them is that you can pay that back over 10 years. So there's a much longer timeline. Now, those are SBA loans are usually for, the debt is $5 million or less. So depending on the value of the deal, that may be a tool that you can use. Some of the recent changes with respect to SBA that are significant that you should be aware of is, it used to be that the down payment was 10%. So instead of 50% or 40% for SBA, it could be 10%. They recently changed the rules. It could be even lower than that. It could be a seller note. It could be 5%. So they've considerably changed the rules. Now it still has to be acceptable to the bank and it still has to cash flow, but it's even more easy to get to use SBA if you're in the market for something that's where $5 million would work. They also changed the affiliation rules.
One of the things that they changed was allowing business owners to buy out other business owners using an SBA loan. That strikes me as a huge issue. What's your take on that?
Yeah, I mean, when I left SBA in 2019 and I got to the bank and we were doing, these deals, and when we used SBA, they always, were like, the owner has to exit within 12 months. The owner has to exit. And I always ask the question, not being at a GovCon instead of financing, I was like, why? I mean, we want the owner around. Maybe the owner might be very helpful. That's going to make the business stronger. So I never really understood that, and so they did change that rule, so the owner is allowed to stay around, and you can do. They could stay on even as an equity owner. The SBA does have a personal guarantee requirement. So if you're going to try to take advantage of that, where you're going to sell majority control to someone else, but stay on as an equity owner, the 20% owners will have to also personally guarantee the SBA loan. So that's something to keep in mind and consider. They did change the affiliation rules, so you can actually qualify for an SBA loan based on it's 50% ownership and NAICS codes versus you may not qualify under government contracting. So that is a nuance to be aware of. And then, as I mentioned,
I'm sorry, Ken, can I ask you to explain that a little bit more? I'm not sure what you just said.
In order to qualify for an SBA loan, you have to qualify as a small business.
Right.
And how do we deal with your affiliates? It's not just you and your size, but we have to look at if you're affiliated with anyone. Now, under the SBA rules for financing, it's kind of based on 50% ownership or above. You control that business, and there's a NAICS code review. We could probably do a whole hour on it, but that's different than obviously under GovCon. You can control business if you only own 5%, if 20 people own 5%, or there can be, there's a lot of other ways to be affiliated that they don't have for financing. Now that's helpful for if you want to use SBA to do a veterinarian business or buy a hotel or whatever. When it comes to GovCon, you just have to be aware that there are some differences between the affiliation rules.
Understood. Thank you.
Yep. I wanted to mention two other things. I thought there was an important case called Vectrus, J&J Facilities, that has to do with predecessor entities. It involves the large business, but it's very helpful for our market and for buyers. Basically, the company bought another company. They had a lot of contracts that they wanted to use from the acquired company for a competition. But the novation process is long and it takes a long time, and there were a lot of contracts. And so they submitted a bid and told the government, we've novated some of the contracts. The other ones are still under our control. They're totally within our control, all the employees and everything, but they're in a subsidiary, but they're going to be novated eventually. The solicitation said that you couldn't rely on the past performance of subsidiaries. Someone protested. There was a series of protests that went on for several years. And in the end, those contracts all were novated over, and the government affirmed their decision. The Court of Federal Claims was sympathetic to that. They recognized the importance and how hard it is to novate, but at all times they controlled it, and they were a predecessor. And so it's very important for the part of the FAR that says for past performance, you can rely on the past performance of predecessor entities. So that was a significant case that came out a couple months ago. And then one other thing I wanted to mention about 8A. 8A is difficult because if you have 8A contracts, you need to get SBA approval basically before you sell, and you usually have to sell to another 8A. That can limit valuation to some extent. But they did change the rules to at least give themselves a time limit on when they have to approve the waiver. Previously, there wasn't a time limit and it could go on for a year. It does have to go all the way to the administrative SBA. but they did put a 90-day time limit on it, so that's helpful. They also removed some language about having to have experience in the industry that you're trying to acquire, because one of the reasons you acquire is to get experience and past performance. So it really didn't make sense, and it wasn't statutorily required. And then with respect to ANCs, tribes, and NHOs, they've made a change around change of ownership for graduates. So even if you're a graduate and you have 8A work, you're supposed to get a waiver from SBA. And that does have to go all the way to the administrative SBA. But if an entity acquires you, there's a way to do a change of ownership, which only has to go to the head of the 8A program, not all the way to the administrator, and it has a 60-day kind of time limit on it. So some improvements for 8A concerns that want to buy or sell.
Terrific. Todd, time for you to pick up the ball. Go for it.
All right. Well, thank you all very much, and thanks to Sharon and Jennifer and SB Liftoff for putting together this webinar today. It's a real pleasure to be here with you all, and amazing to have 3 lawyers on a panel together.
Well, I'm a recovering attorney. I can't. I don't
yes.
claim lawyer status anymore.
So I'll try. I'll be the boring one here and actually play the role of lawyer and talk through a few things that I'm seeing in 2023 and some predictions for 2024, at least in the legal context. So first, I wanted to address regulatory issues affecting transactions and how to recognize and mitigate that risk. There's 3 different things that I'm seeing that I think I wanted to emphasize to the group today. One, as we all know, there are elongated procurement cycles with contract award delays and recurring protests, and now, of course, the imminent threat of government shutdowns. All of that impacts growth visibility for buyers and sellers. And so thinking through that in your M&A cycle is critical, and it can impact, obviously, and we were talking before about backlog, but just in terms of, where the market is going and where your business is going. So you have to recognize that and think through that. And one thing that we've seen is, while obviously GWACs, the big ones, will still be the meal ticket and will still be what increases your value and attracts certain buyers, given these elongated cycles, agencies have turned to some other contract mechanisms to achieve their mission. And so I think understanding these creative contracting vehicles is critical to your business, and thinking are there ways that you can go after some of these creative contracted vehicles? And those would include, we're seeing more SBIR Phase 3 IDIQ vehicles. Obviously, we have OTAs and the proliferation of OTAs. There's the final implementation of DoD's commercial solutions openings procurement cycle. And you have, I think, the growth of agency agnostic BPAs. And so I think about trying to add to your portfolio of contract vehicles some of these creative contracting vehicles that could add some value to your pipeline.
Todd, if I can interrupt you there for a second, it's really important to understand what Todd just said. I have a huge number of people who want to sell their company and coming to me and say, I have an IDIQ that was very desirable, CIO SP4 or whatever it might be, but I have no task orders under it. And the vehicle itself has pretty minimal value. The vehicle itself is a hunting license, and it is certainly possible that somebody might buy your company in order to get that hunting license if they think that they can do a lot with it, but it's not worth millions of dollars. So it's a really challenging situation for business owners, because on one hand, we pound the table about how important it is to have important IDIQs and big contracts and all the rest of it. On the other hand, having those vehicles without having task orders under it, it does not maximize the value for that business owner. So just understanding that having the vehicle itself is not a significant enhancement to the value of your company is important. You've got to win the task orders under them.
And the other thing I'll add to that is that it was a lot more important 4 years ago, 5 years ago, when this strategic sourcing, or I guess category management, was kind of hitting people in the face, and they didn't know it was coming, so all of a sudden you didn't even know about Oasis, and now your work's going to that. Now we've seen enough where there's, the government is doing more on ramps. There's been memos from OMB on using other kind of mechanisms to meet your goals. So it's not as a desperate situation as it felt like 5 years ago when people were hit with this unexpectedly.
Agreed. There was a time where, your company does not have value unless you have these important IDIQs or big contracts. That's turned out not to be true. And so as a business owner, you've got to think about the appropriate reallocation of resources between trying to get these vehicles and determining, as well as the risks of protests, delays. I mean, some of these have been going on for an extended period of time at this point. So getting, sole award contracts, hey, listen, backlog is backlog is backlog. And, I've not found banks, and Ken, I'd be interested in your view on this, to say they've got a lot of backlog, but it's not from under an IDIQ. It's under, it's basically a direct award contracts. I've not been seeing banks get nervous about that and saying, I'll lend less because it's not an IDIQ. Ken, what's your take on that?
Absolutely. Money is money. It could be a BPA, an IDIQ, an SBIR, an OTA. I mean, you have to have a bank that understands that, but the money's going to come and it's going to flow.
I'm so sorry, Todd. Go back to you.
No, it's great. The second regulatory issue that I'm seeing, and I think we'll continue to see, is probably the one thing that Biden and Trump agreed on, which is domestic content preferences. There's tremendous emphasis in the regulatory space right now on compliance with whether it be Buy America, Buy American, BABA, TAA. I can go down the list. There are increased enforcement mechanisms. There are increased settlements. And so this is an area as part of a kind of your regulatory due diligence that's important to look at not only your current compliance in terms of the contracts that you have, but also from a buyer perspective and making sure that the target understands not only the contracts it's signed up for, but the certifications that it's made in connection with that. Now, obviously, there are certain sectors where this will be more important than other sectors, but it is a very important regulatory issue that will, I think, really come to light in the coming years in terms of how it impacts potentially even evaluation of certain targets. The other kind of third issue I want to mention from a regulatory perspective, and this can impact small deals to extremely large deals, and it's something that we don't think about a lot in the GovCon space, but it is obviously important, particularly when you are doing national security type work, and that's CFIUS. And making sure that you understand as the seller the impact of CFIUS on the potential acquisition timing, acquisition cost in terms of lawyers you have to have involved, and making sure that your buyer understands the CFIUS implications as well. And CFIUS is Committee on Foreign Investment in the United States. And so this is really an issue that a buyer needs to think about when looking at particular targets, but sellers need to confirm that there is no foreign ownership in a buyer that would actually trigger CFIUS review.
That's an excellent point, Todd. SB Liftoff did a transaction about a year ago of somebody who our client was the seller. They had only sub work, but they had a lot of it at the State Department. And the party that came in to do an acquisition was a foreign-owned entity. Ultimately, they were a U.S. company, but if you went up the chain, it was foreign-owned. We ultimately decided not to go with them for the CFIUS reasons, that the time periods involved in getting those kinds of approvals were extensive. And there were several break periods in there where it could be 60 days, but if they decided to take a different route, it could be, 9 months. And as an M&A person, one of our mantra is time kills deals. And it doesn't make a lot of sense to have a willing buyer and a willing seller hanging around for another 6 or 9 or 12 months waiting for government approval, which is one of the reasons why so many of these deals are done as stock deals as opposed to asset deals. So that's CFIUS. If you're a buyer, you care a lot about if you're a seller, you care a lot about who that buyer is. And if you're a buyer, you have to realize that you have some disadvantages and you're probably going to have to pay more in order to keep a seller sitting in their seat. Todd, does that comport with your experience?
Definitely does. And I just wanted to mention a couple more things about CIVIS, just people keep in mind. There was a conference about 2 weeks ago that the press was not allowed at, but there have been some reports on what was discussed. And CIFI has identified actually key areas of focus that it's focusing on: cybersecurity, supply chain, clean energy, and dual use technology. So that's an area that they are dedicating resources to. They are trying to create what they're calling a culture of compliance now inside CFIUS, and they even hired a chief counsel for enforcement, and they're going after parties that fail to file what we call mandatory declarations. And in fact, in 2023, they're on track to have more civil monetary penalties for failing to file with CFIUS than in all of CFIUS history combined. So really what that means is that they're wanting parties to have greater kind of pre-filing diligence and understanding the potential nature of the threat, that is not only who the foreign investor is, but also the target technology. And they're asking parties to use the joint voluntary notice process to provide facts to CFIUS, not just regulatory conclusions. And I think the thing to look out for in 2024 in the CFIUS front is new regulations. But I think what Sharon says the most important, it's really, particularly from the seller side, really assessing your buyer and trying to figure out whether that is the buyer you want to go with if you're going to have to go down the CFIUS front. The next topic I said I would talk real quickly on is upcoming CMMC. I think we're all familiar with that fun acronym, and what will the impact be in the M&A space. And just a little background first. As many of you know, this was announced back in 2019. The CMCC program establishes 3 levels of cybersecurity protection, and even with the implementation pending, coming into compliance can take time, and contractors should be working to implement necessary controls now. OMB released some scoping documents a few months ago, and while these are not final, they are most likely are a glimpse into the final versions of what the levels will look like within CMMC when it becomes fun. Level 1 being that specialized assets won't be in scope of review. It will require a self-certification and require the contractor to produce a self-assessment report. Level 2 is where specialized assets will again not be in scope, but that's where it will require the third-party assessment to be CMC approved, and the contractor has to produce that assessment report. And level 3 certification, specialized assets will be in scope, and the government themselves will actually certify the controls. So the OMB guidance also reference some unreleased regulations, which kind of portend the issuance of full suite of regulations soon within CMMC. As we understand that the DFAR rule is with OMB right now, and so if the rule is released as a final interim rule, we could have CMMC very soon, or most likely, I think, sometime next year. We've heard some 2025 guesses as well, but I think the point is, what does this really mean for M&A today and M&A next year? First, there's just an increased level of focus on cybersecurity and NIST 800-171 diligence, period. This is an area that even like 5 years ago may have been at the bottom of the list of the diligence chart, but it is now like front and center. And whether you're the smallest of the small or the biggest of the big, this impacts you the same. There is no small business exception for cybersecurity protection. There is no exception for DFAR 7012. There's no commercial items exception. So this is impacting everyone. And so it really is important, particularly from the buy side, as when I'm representing buyers, to figure out what has the target done, what do they have in place, and how quickly, particularly for the rollout of CMC, can they get a third-party assessment done once they become available. Not having these types of security controls, or at least not even having their self-assessment report done, obviously creates compliance risk and compliance issues. This is an increasing area of False Claims Act exposure. There are a number of whistleblower cases out there that have been settled in recent years involving non-compliance with cyber NIST 80171. And so it's a very important area of diligence. And so while, yes, it impacts compliance today, it obviously is going to impact the ability to pursue future work, right? Because the thing about CMMC is that we're putting the burden on the government to identify the level of cybersecurity protection for an RFP. So we might, file protests and things like that about whether it really requires level 2. But if they say level 2, then that means that in order to bid, you're going to have a third-party assessment, period. So it's another barrier to entry or gateway, in order to bid on a particular procurement. And so all this infrastructure and all this work from a security control perspective has to be done in order to compete and potentially compete for work they have today if the government identifies, higher level security on down the road. The last thing I want to touch on before I turn it back to Sharon and Ken and have a dialogue on some of these points is the kind of the value add options that are associated with these we'll call kind of new quote unquote types of teaming agreements, which really are mentor protege agreements and mentor protege joint ventures. We could probably have a day-long seminar just on these things, but I think it's important to note just the amazing growth in this area. SBA's Excel spreadsheet as of 8/1/2023 identifies 2,617 mentor protege agreements. Now that's back from when they started issuing them back in 2016. So if you assume the 6-year life, you take away about 500 or so of those, that means about 2,100 active mentor protege agreements in our industry. That's quite a lot, particularly given the limitations of the numbers of proteges that mentors can have and vice versa. So what does that mean first and foremost from an M&A perspective? Well, if your target is a mentor or a protege, you need to understand the mentor protege agreement. You need to understand the obligations that have been either promised or will be received thereunder, and confirm that those obligations have been met, or at least they've been tracking and those things have been being provided. You also have to then think about confirming your obligations to confirm the validity of those agreements post-acquisition. With this amazing rise in mentor protege agreements, we've also now seen, really even the last couple of years, this proliferation of mentor protege joint ventures bidding on and winning all types of contracts and contracts vehicles. So again, what does this mean from an M&A perspective? One, I'd say, these mentor protege JVs are a protest target. This is a protest-rich environment, really more from a size and status protest perspective, necessarily than a GAO protest, but there are a lot of size and status protests, basically claiming that people didn't do the joint venture correctly, and oftentimes people are right. But let's say you did it correctly and you have won an award as a mentor protege joint venture. Well, from an M&A perspective, you really need to focus on the JV governance and looking at the operating agreement and understanding the rights that the mentor and or protege have, depending on who your target is in that joint venture agreement. Also needing to confirm, from a diligence perspective on the JV itself, the contractual relationships that it has entered into to support the contract, and how the managing venture is actually meeting the prime contract obligations. We haven't talked a lot about private equity in our time yet, but I'm sure we'll talk more. But despite the availability and pricing of debt, the private equity has remained very active in 2023. Both not only looking at new platforms, but also at tuck-ins to existing portfolio companies. As Sharon mentioned, there are a lot of new entrants in this space, and those new entrants create a knowledge gap and need to educate the buyer and on the seller side. I think these mentor protege joint ventures, particularly those that they provide an opportunity for private equity to jump into something at a kind of a different level than they might have before. And so I'd look at this as an area potentially in 2024 as these mentor protege joint ventures get more established and win actually more work, that these might also become a target for private equity down the road.
I wanted to say two things on the joint venture issue, mentor proteges particularly. Unlike what Ken and I joked about a few minutes ago, not all revenue is equal. If you have 100% of your revenue coming into your company, that is considered more desirable than if you had a situation a couple of years ago where 85% of the revenue was coming in from the JV. And buyers were very nervous about that because they're basically saying, not only am I buying this company, I'm basically going into a long-term relationship with this mentor, and I need to do due diligence on them and what kind of people are they and all the rest of that. So JVs have all sorts of advantages, but they're not without some weight that you need to deal with. Second is, it feels as though this growth in JVs is in part due to the category management and these larger BIC and IDIQ contracts where you needed to have the past performance that some of these smaller companies couldn't have, and the only way they could do it is by having a JV. It does seem as though some of these processes are bogging down and they're going to other contracting vehicles. So just purely speculating whether or not the JV rush will continue with the same level of frenzy that it has if in fact different contracting vehicles are chosen.
Yeah, I was at SBA when we started both the 8A mentor protege back in '98 and the 2016 all small. It was really intended to be teaming up with a large business to build a building or build a database for someone, do a project. It wasn't contemplated that we'd have these 10-year contracts where everybody's being pushed to do IT on these BICs or do consulting on these BICs. So I think there is some talk about, has it gone too far? Just like anything else in government, you make a rule, then you have to adjust to it. I think that is going to be something that may happen, but it as with anything, it takes time to adjust to it.
Anything you wanted to mention on that?
I want to mention, just from an M&A perspective, and I had a deal close earlier this year where the target was the protege. The protege had very limited business. The protege's primary asset was its 51% interest in a mentor protege joint venture. And so that was the whole reason for the acquisition.
Very interesting.
Again, from an acquisition strategy standpoint, I mean, it is a way to get, to basically get your way into a contract vehicle that you hadn't thought you might get there before. So I just would keep it out there. And I agree with Ken. I do think I've been speaking and writing on this for years. And I do think that this is an area that SBA will likely have to rein back in at some point, because it kind of created a wild, wild west. And I think we're seeing that play out. I think there's some good things that have come from it. I think there's some negative externalities as well, but we'll look to see what SBA does in the coming years.
Unintended consequences. You never know.
Yeah, I mean, that's just part of the nature of rulemaking, but there are some even things around past performance where GAO said something was okay and the Court of Federal Claims just said, no, you can't even do that. You have to even have less from the protege, which makes the mentor even more important. So there's definitely some concern there about, what do we need to do to make adjustments?
I'd like to turn, if we could, to some of the questions that we have, because I don't want to lose that opportunity. Jonathan Morgan has said, for searchers, entrepreneurs through acquisition in this space, how does acquisition of a target that has significant designation market value influence holding period considerations? How does that impact decision-making by potential investors in a search vehicle? And the answer is it has a tremendous impact. And it also depends upon what designation you're talking about. 8A is a very challenging situation. It's very hard to do a ETA with an 8A company. You need to be an 8A company in order to acquire an 8A, and it's hard to get that designation if you're just coming into the market. So let's put 8As aside. If you're talking about a small business, then it really just goes by the size code. And as a general rule, it's very challenging to work with any kind of investors that have affiliation with other assets and have them be your investors. It can be done. It has to be very carefully structured. We've done 3 transactions where the acquirer was essentially a PE fund, but they didn't have a fund. All of their money came from individual limited partners, and we were able to structure something so that the target was able to maintain its small business designation even after the acquisition. And that was hugely important. So that could be done with kind of traditional search investors, but it's complicated. It can't be done if it's going to be out of a fund. In contrast, if you're buying something that's got SDVOSB, that's even harder because there is a 51% ownership by the veteran and very clear rules about what are the control provisions that the non-veteran is allowed to have. So search funds have a very challenging time on that. One of the ways that you can get around it for small business and women-owned is by using SBICs, the Small Business Investment Corporations. And they can do funding that is exempt from the affiliation rules. So if your backer has an SBIC fund, you're okay. If it's, again, funds under management, you're going to have a problem. Those SBIC funds, however, do not work for a veteran-owned company. So there's very specific rules. And as a general rule, it is very hard to be a searcher backed by a fund and trying to buy a company with designations. Gentlemen, what is your thoughts on that?
Yeah, I mean, recertification is definitely a requirement. If it's a small or some kind of socioeconomic set aside, you're going to have to tell the government if you're no longer small, you're no longer an SDVO or women owned or so forth. Generally speaking, that just changes the counting of that contract going forward. So the government won't get credit if you say, I just bought this company, there's 2.5 years left, I'm not small anymore. Usually the government may not care. They're going to say, well, the performance is good, we won't get credit. Now, obviously, for the recompete, you wouldn't be eligible, but there is a way to at least continue performing the contract that you're buying. Although some contracts are very specific, like Oasis, and it says if you recertify, you can finish orders, but you can't compete for any new ones, and you can't go to the unrestricted portion of Oasis. And then there's other IDIQs that say if you're small and you recertify as other than the small, you can now just go to the large portion. So there's very contract specific issues, and then there's general FAR provisions on recertification, but it's definitely an issue that has to be considered when you're getting into buying someone that has any kind of small work.
The way in which I think about it, and maybe this is too broad, is if the buyer cannot recertify, they don't lose the work that's in backlog, but they might have a very significant challenge in being able to recompete that work unless the designation requirements are changed. So you don't lose the work, unlike an 8A where you could, but it does impact the value for the seller. So again, the seller needs to care about who the buyer is, because if that buyer won't be able to recompete that work, they're likely going to put less value on it than if they could recompete it. Todd, your thoughts?
Yeah, I completely agree with everything that is said. And in my experience, I've been doing deals in this space for a very long time. I can't think of a situation where there was a T for C after a deal and you could no longer certify you were small. But that if it's going to happen, it's going to happen if the contract is in its first or second year. It's too costly for the government to reprocure. They don't want protests. They want the people they have. They'll deal with the loss of designation. I mean, geez, you've seen we've been busting through small business goals the last couple of years. So you lose a little bit here or there that's not going to impact. And I do think, interestingly, this is where these mentor protege joint ventures come into play, because they can be your recompete strategy. So you can think about how it is you're going to recompete post-acquisition, as long as you have a mentor protege JV set up to be the bidding entity when it comes up for recompete. And obviously, Sharon structures these all the time. But if there is a real concern, you can structure earn-out provisions so that there's a way to capture the value for the seller if there's some concern that a particular customer might terminate a contract early.
Okay, I hope that answers Jonathan's question. I'd like to move on to Scott Esham's question, who starts off by saying he's a very happy client of Todd. So I'm just putting that out there. He's not my client, he's Todd's client, and he's very happy. So going on from there, his company is small but growing. They don't have an advisory board, still 100% founder owned. They're thinking about adding an advisory board and potentially giving out equity. Can you address implications for the advisory board? How much equity is standard? Ideal number protecting the cap table for a firm that's interested in later M&A. I'm going to give my perspective, and then, gentlemen, please give me yours. Be very careful about giving out equity. That's a very complicated situation to do, and relationships that you think are going to be fantastic may turn out not so much. And then having to get that equity back is really a challenge. I find that, first of all, there are no norms. This is kind of all over the map. It's sui generis. If anybody tells you that 10% of the equity goes to an advisory committee, they're just making that up. There's no standard. You have to do what makes sense for you. What I have found working well for people is some type of advisory board with some cash associated with it, and that cash can be deferred. It can also be pretty modest, with the idea that as the revenue of the company goes, there can be more cash to the advisory board. But I would certainly not start by giving people equity until you've got a better sense as to how you work together well, getting a year or two under your belt, because, cash is one thing, equity is a much more complicated situation. So, I'm hesitant. Doesn't mean that you shouldn't do equity, but be very careful about it. And I wouldn't do it immediately upon creating that advisory board. Todd, what's been your experience on this?
I completely agree. I like the idea of very modest cash payments, and actually really like the idea of tying any cash payments to, or increasing cash payments to, the growth of the company. Because an advisory board, that's really what they're there to do. They're to help you to think about how to grow the business, maybe open some doors to some new markets, some new partners, and the incentives are aligned in terms of the growth of the company. So yeah, I would agree. No equity at first. Maybe if they're a really good board member on down the road, you can think about it. But we'll want to make sure we structure the equity grant appropriately.
And you also, yeah, I just want to say you have to be not just on the advisory board, but just in terms of equity. There's equity, the percentage that they own, but then there's also bylaws and negative controls. And the more things you start giving away to minority investors, the more likely they may be found to control you, and then you'll be affiliated with them. So you have to be careful, not just about the equity, but what kind of controls you give them.
It is certainly possible to sell a company that's got, a majority owner and 5 or 6 or 10 separate owners. Absolutely doable. It is a little more expensive. It is a little bit more complicated. So, you understand that it's just a little bit more lumbering when it comes for an M&A. Now, on the counter side, if you give true equity, you want to do it at least a year before you go to market. Because you're not going to, those equity owners will not get capital gains treatment unless they've owned that equity for at least a year. My feeling is that equity are for people who take a significant financial risk and who put some cash into the company and were there during the lean years. And cash is for people who come there and help you grow it. So really think through what is the appropriate scope for your people. So Scott, I hope that that's a helpful answer for you. Another question that came in is from Richard Goody. What are your thoughts on government contractor companies which have 100% government subcontract work, providing the primary information technologies SMEs are trying to sell? And what is a reasonable expectation 2 times, 3 times, especially if contracts are in place for 5 years plus? Let me take a first shot at that one. The first issue is not all subcontracts are equal. If you are doing commodity level work, and God forbid you're a sub to Booz Allen, you can't really count on that. Booz Allen will cut you because it's Tuesday. So don't feel like, I've got subcontract work, I can take it to the bank. You really can't. On the other hand, if you're doing subcontract work that is extremely specific and kind of non-commodity, high-end, as you're saying here, information technology work that is not easily replaced, then it's more likely that after a transaction, that work will continue. So that, again, not all subcontracts are the same. It is true that subcontracts are valued less than prime contracts. The government does not like to cancel contracts unless you're not performing. Where subcontracts can get canceled all the time. So it really depends upon the relationship between the prime and the sub, and what kind of work is being done, et cetera. If you're doing pretty good subcontract work and have a deep relationship with that prime, and it would be hard to replace you, I think that it would be reasonable to expect an EBITDA multiple of 4 or 5 even. I think 2 or 3, which is what Richard is suggesting, is a little bit on the low side. And truth is, if you have subcontract work that's likely to be replaced, I'm not so sure that a buyer is going to pay you a heck of a lot for that. And you're probably going to get more on an earn-out basis to make sure that they get the work in order to make sure that they have the money to pay you. Ken, what's your thoughts on that?
Yeah, and I totally agree with what you're saying. I mean, subcontracts can be terminated pretty easily unless there's something in the subcontract saying it's not. They can just take it in-house or get someone else if it's something that anybody can do, or there's hundreds and thousands of companies that could do it. I also think to some extent the the prime work, they care more about their goals at the prime level, in my opinion, than maybe a prime would care about their subcontracting goals. Heaven forbid I say that, but they have a plan, but it's not number one in their position. So if you're doing really good work and you used to be small and they were counting you towards their goals as a subcontractor, and now you're large, I think it's easier for them to find some other small to do something else to replace that number in the grand scheme of all the work that they're doing. And I don't think it's going to be as much of a concern changing from small to large if you're a subcontractor. So that's kind of one positive from my perspective.
Excellent point. Well, we have 4 minutes left in this.
Sharon,
sorry,
can I
Todd,
jump in?
please go ahead.
Just two quick things on that. Number one, if your subcontracts can at least tie your termination to if the government terminates the prime or your scope of work, that'd be helpful. It'll make your subcontract stronger. And second, in terms of the type of work, if you're doing classified work and you got an FCL, I think Sharon would agree that's going to help your valuation. There are still a lot of buyers out there looking for FCLs. Because the FCL process is still very time consuming. And so if your SMEs are cleared and you're doing classified work, I think that will increase the valuation of your firm.
Completely agree. All of those kinds of, I refer to them as certifications. I mean, having a facilities clearance makes a huge difference. Having the ISO certifications, CMMI, level 2 or 3, all of those add value. And they add value by increasing the multiplier for your your adjusted EBITDA. So it's pretty darn important. Want to give the audience an opportunity to ask any further questions, but while we do that, Ken, would you like to make any closing comments?
One thing we didn't talk about at length is diversification and how important that is. If all your work is under one contract, that's going to make it a lot more risky because obviously you may not win the recompete or the government may not like you. But you also have to understand that if all your work is DoD, that's not the same as having all your work at a small bureau. DoD spends hundreds of billions of dollars, and even within them, there's Army, Air Force, and Navy. And within Navy, there's NAVSUP and NAVAIR. So diversification has to be understood by the buyer and the seller and the bank you're working with.
One more reason why you want to be working with buyers who actually understand GovCon. You could look at it as that all of your contracts are with the federal government. So you've got 100% client concentration. It's like, well, yeah, but. So you want to have somebody who is a little more sophisticated on GovCon. Todd, closing comments for you?
Last comment for me would be, don't be afraid to reach out to an advisor at an early stage. I think this has been it's a very nice panel in terms of the different organizations that we come from. I think it's important to, particularly if you are thinking about doing a transaction, buy side or sell side, to reach out to an advisor early on to understand the implications of a potential transaction.
Completely agree. My statement is going to be exactly the same. Reach out early, reach out often, particularly for those folks who are not going to charge you for those conversations. But there's a lot to learn. Starting a company is very hard. Keeping it going is even harder. A GovCon, I think, brings its own challenges. The fact that you're able to do this is phenomenal. Do not beat yourself up for not being an expert on M&A. Nobody expects that you will be. But get information, talk to people, go to webinars like this, have some conversations, because it's much easier to hit your goal if you know what your goal is. Jennifer, I'd like to turn it back over to you.
Thank you. Great discussion. It was a pleasure working with you all. I want to thank Sharon, Todd, and Ken for a great discussion. And to everyone who attended, thank you for joining us. And please, if you have any questions, don't hesitate to reach out. Have a wonderful day, everybody.